The US government issued a formal directive on January 14th of this year. Most people have never heard of it. The mainstream financial press walked right past it. But buried inside that document is a deadline, 180 days. And that deadline expires on July 13th, 2026, less than 80 days from tonight. That directive specifically instructs the Treasury Department and the U.S. Trade Representative to implement price floors for critical minerals. Silver is on that list. It has been classified as a critical mineral for years. And what that directive means in plain terms is this. The United States government has formally committed to a policy response for silver prices. And the clock on that response is already running. Now here's where this stops being background policy and starts being something you need to pay very close attention to if you hold physical silver, if you have been watching this market, or if you are trying to understand where the next major price catalyst comes from. 4 days from now, Thursday, April 30th, the COMEX silver market faces its most critical delivery test since this bull market began. There are 135 million ounces of silver currently under contract on the May futures. There are 77 million ounces sitting in the registered vault. That gap, 58 million ounces, represents the difference between what the exchange has formally promised and what it can physically deliver. By Thursday, that gap has to be resolved. And based on what happened the last 2 times this exchange faced this exact kind of pressure, what comes next is not going to look like a normal market day. I am going to walk you through every piece of this. The COMEX inventory drain, the White House directive, the gold options market signal that almost nobody in financial media has connected to this story, and why every single one of these forces is converging on the same 30-day window this July. When you stack these signals on top of each other, July is not just another month on the calendar, it is a convergence point. And tonight, I want to show you exactly what that convergence looks like and why it matters for every person watching this who has exposure to precious metals. This is Recession Warnings. Let's get into it. Silver is down about 0.83% today. Gold is off 0.12%. Price is sitting in a tight range. On the surface, that looks like a slow, boring Monday. It is not, because the price on your screen is not the story that matters tonight. The number I need you focused on is 135 million ounces. That is the current open interest in the May silver contract on the COMEX. Von plots approximately 26,963 contracts, each one representing 5,000 troy ounces of silver. If every single one of those contract holders decided to stand for physical delivery, the exchange would legally owe 135 million ounces of metal. Now, here's the number sitting on the other side of that obligation. 77 million ounces. That is the total registered silver inventory at the COMEX tonight. Not estimated, not eligible. Registered, meaning it is vaulted, verified, and legally designated as available for delivery. 135 million ounces of contractual claims. 77 million ounces of physical metal to back them. That is not a rounding error. That is a $4.5 billion gap between what the exchange has promised and what it holds in its vaults. And Thursday, April 30th, first notice day for the May contract, is the date when that gap either gets managed quietly behind closed doors or becomes impossible to ignore publicly. You need to understand what is at stake before Thursday arrives, because by Friday, the window for calm analysis will have already closed. Here is the trajectory that makes Thursday's deadline so consequential. In October of last year, the registered silver inventory at the COMEX sat at approximately 157 million ounces. Tonight, 6 months later, it is 77 million. That is a 50% collapse in the available silver backing, the largest silver futures exchange in the world, inside of half a year. That number alone should stop you. A 50% drain in 6 months with no meaningful offsetting inflows is not normal inventory movement. That is a structural withdrawal. But it does not stop there. Beyond registered silver, there is also what the exchange classifies as eligible silver, metal that is physically stored in COMEX, approved vaults, but has not been officially designated for delivery. It could be held by hedge funds, ETFs, third-party custodians. In theory, some of that eligible silver could be converted to registered status and become available to cover delivery demand. That buffer is disappearing as well. The eligible silver inventory has dropped by over 100 million ounces in the same 6-month window. Both lines, registered and eligible, trending down hard and continuously, no reversal, no stabilization. When a market's internal supply reserves are draining at this pace with no offsetting inflows, that market is telling you something with unmistakable clarity. Production is not keeping pace with consumption. Withdrawals are exceeding deposits. The inventory available to back paper obligations is being cut in half while those obligations remain enormous. The market is speaking directly. The question is whether you're listening before Thursday or after. Now let me walk you through what Thursday actually means in mechanics, because the numbers only make sense once you understand the deadline structure. First notice day is the date by which any contract holder who intends to take physical delivery must formally declare that intent. After that declaration, the clock on delivery begins. For the COMEX to navigate May without a structural failure, fewer than 15,000 contracts can ultimately stand for delivery. The arithmetic is exact. 15,000 contracts multiplied by 5,000 ounces per contract equals 75 million ounces, essentially every registered ounce currently in the vault. If 15,000 contracts stand, the entire registered inventory is gone. Right now, the open interest still represents 135 million ounces. Between now and Thursday, that number must come down dramatically. In previous delivery months, it did come down, but not always through voluntary market mechanics. And this brings us to a pattern that deserves to be examined directly, because it is not a rumor, it is a documented sequence. In December of last year, in the days immediately before first notice day, the COMEX servers went offline. The stated reason was a technical infrastructure issue. The timing was precise, landing on Monday and Tuesday of that critical week, exactly when behind-the-scenes pressure would need to be applied to contract holders considering standing for delivery. What happened during those 2 days behind the curtain of the outage was a quiet negotiation campaign. Contract holders were persuaded to roll their positions forward rather than demand physical metal. Cash premiums were offered. Institutional pressure was applied. And the exchange survived May without a vault crisis, but the registered inventory still took a hit. In February of this year, the same sequence repeated. Server outage. Same timing relative to first notice day. Same outcome. Contracts rolled, delivery demand managed, exchange survives. This is now a pattern across 2 consecutive delivery cycles. 2 outages, same critical window, same resolution. And if the open interest heading into Wednesday of this week is not declining at the pace the last 2 cycles required, the probability of a third outage, a third force majeure dressed up as an infrastructure problem, is not theoretical. It is what the data predicts. Manage the contracts, survive the month. But whatever is left in the vault after May determines whether July is survivable at all. Let me connect this directly to you, to the physical holder, to the stacker who already has silver in hand, to the person watching this who has been waiting for clarity on what the next major catalyst looks like. If the COMEX executes another managed rollover in May, the price does not crater. It gets managed sideways in the short term, but the registered inventory still takes a hit. And here is the scenario the sharpest analysts tracking this market are focused on. If 10,000 contracts, not 15,000, just 10,000, stand for delivery in May, 50 million ounces leave registered inventory. That brings the total down to somewhere between 20 and 30 million ounces. At 20 to 30 million ounces of registered silver, the COMEX is no longer credible as a global price-setting mechanism. You cannot set the worldwide silver price from a vault that holds less metal than the exchange you are supposedly competing with on the other side of the world. And that is not a hypothetical statement. China's combined silver inventory across the Shanghai Gold Exchange and the Shanghai Futures Exchange currently sits at 36 million ounces. In March of this year alone, China imported 27 million ounces of silver, the largest single-month silver import in Chinese recorded history. If May's delivery cycle draws down 50 million ounces from the COMEX registered vault, the United States primary commodity exchange will hold less physical silver than China's national exchange infrastructure. Think carefully about what that means for price discovery. The COMEX currently sets the global benchmark price for silver. That benchmark is only credible if the institution behind it holds enough physical metal to back its obligations. The moment Chinese exchange vaults hold more silver than the COMEX, the argument that America sets the world's silver price does not just weaken. It becomes structurally indefensible, and there is one more data point arriving in 4 days that tightens that pressure further. Starting May 1st, China is restricting exports of sulfuric acid. Sulfuric acid is not a peripheral material in this context. It is a primary processing input for copper ore refining. And approximately 1/4 of the world's annual silver supply is extracted as a byproduct of copper production. Restricted sulfuric acid flowing out of China means less copper ore being processed globally. Less copper processing means less silver coming out of the ground as a byproduct. Less silver supply, arriving at precisely the moment when COMEX inventory is already at a 6-year floor, when White House directives are mandating price floor negotiations, and when Chinese exchange vaults are accumulating at record pace. This is not coincidence layered on top of coincidence. This is coordinated policy with a directional outcome, and all of it is pointing at the same 30-day window. Now I want to show you something happening in the gold options market that the mainstream financial press has almost entirely ignored, and which connects to the silver picture in a way that should make every precious metals watcher pay very close attention. On the COMEX, there are December gold call options sitting at strike prices of $10,000, $15,000, and $20,000 per ounce. To put that in context, gold is trading at approximately $4,975 tonight. These options require gold to more than double, triple, or quadruple from current levels just to break even. Each contract represents 100 ounces of gold. The open interest at those three strike prices is as follows. At the $10,000 strike, 8,400 contracts. At the $15,000 strike, 20,000 contracts. At the $20,000 strike, 21,000 contracts. The combined value of those positions is approximately 30 million, and that number is growing. On the last trading session alone, the total open interest across those three strikes increased by over 1,000 contracts. Now look at what is happening at options that are actually near the current gold price. At the $4,700 strike, roughly where gold is trading tonight, the open interest is 97 contracts. At $4,650, it is 200 contracts. At $4,800, it is 370 contracts. Let that comparison land fully. At the price gold is actually trading, open interest is in the dozens to low hundreds. At 2, 3, and 4 times the current price, open interest is in the tens of thousands and growing every single session. This is not volatility trading. Volatility traders buy at the money straddles. They use delta hedging. They operate near the current price, not at 3 times the current price. What this configuration represents is a directional bet. A bet placed by people who believe a specific price event is coming, either a black swan or something considerably less random than a black swan. Something more like a policy decision that specific market participants have reason to believe is being planned. And if that policy decision is what the data suggests, the implications for silver are not secondary to the gold story. They are the entire point of it. Here's the policy mechanism that makes those options rational. The United States government currently holds gold on its official balance sheet at $42 per ounce. That is the value established decades ago and never updated to reflect market reality. Tonight, gold trades at $4,675. The gap between those two numbers, between the $42 book value and the $4,675 market price, represents an enormous unrealized asset sitting inside the Federal Reserve's accounting structure. An asset that has never been monetized. An asset that could be, through a formal revaluation, converted into treasury capacity without issuing a single new bond, without adding a dollar to the national debt, without a congressional vote. Franklin Roosevelt executed this mechanism in 1934 to retire debt at the depths of the Great Depression. Richard Nixon used it twice in 1972 and again in 1973 to manage the collapse of Bretton Woods. In both cases, the official revaluation price was set below where gold was already trading on the open market. In both cases, after the revaluation, gold kept climbing well above the new official level. If the United States were to revalue its gold holdings from $42 to even $5,000 per ounce, the resulting accounting adjustment would generate the equivalent of $1 to $2 trillion in treasury capacity overnight. No new debt, no printing press, no congressional authorization required. The December gold calls at $10,000, $15,000, and $20,000. The ones accumulating open interest at a pace with no historical precedent. Those positions make rational sense in exactly one scenario. A revaluation that is planned, that is imminent, and that participants believe will not stop at the first announced price level. A layered revaluation, the kind that happened in the 1970s, where the first official price becomes a floor that the market immediately bids through, requiring a second and third adjustment upward. The people buying those calls are not betting on inflation alone. They are positioning for a specific policy event with a specific timeline. And that timeline connects directly back to the White House directive I mentioned at the start of this video. The January 14th proclamation, requiring price floor negotiations on critical minerals, has a 180-day deadline. That deadline is July 13th, 2026. But July 13th is not the only deadline landing in that window. The 60-day trade action plan published by the White House on February 4th, 2026, expired in early April. In the weeks since, U.S. trade ambassadors and senior economic advisors have been deployed simultaneously across 6 major trading partners: the United Kingdom, the European Union, Japan, South Korea, Mexico, and Canada. Every one of those conversations has a common thread: critical mineral supply chains, price volatility, and declining domestic production inside the United States. 3 days ago, April 24th, 2026, the United States Trade Representative issued a public statement explicitly referencing a border-adjusted price floors as a mechanism to strengthen the American domestic critical minerals industry. That language was deployed publicly in the context of active US-EU trade negotiations, 3 days before the most critical COMEX silver delivery deadline in recent history. That is not background noise. That is front-page policy language, confirming that the White House directive is actively being implemented. Now add the USMCA trade review. The agreement governing critical mineral flows between the United States, Mexico, and Canada comes up for its scheduled review on July 1st, 2026. Mexico is one of the world's largest silver producers. Canada is a major source of silver byproduct from base metal mining. The terms under which those metals flow into the United States and the price frameworks governing those flows get renegotiated this July. Simultaneously, a prominent gold bond proposal that has been circulating among Treasury advisors carries a symbolic target date of July 4th. The White House critical minerals deadline is July 13th. 3 deadlines, 3 different originating policy tracks, all landing in the same 30-day window. This is the convergence, and it was not constructed overnight. Now let me address the counter-argument directly, because some of you watching this are already thinking it. The COMEX will never actually fail. The institution is too embedded in global finance. The regulatory infrastructure is too entrenched. And if delivery demand exceeds physical supply, the exchange has a mechanism, force majeure and cash settlement, to resolve the gap without the institution collapsing. You are right, but not in the way that protects you. Here's exactly what cash settlement looks like when it is invoked at scale. Contract holders receive dollars instead of metal. No silver physically changes hands beyond what the vault can accommodate. The exchange survives. The institution does not collapse. But the cash settlement price is not $74.76. It is the repriced price, the price that emerges from the public acknowledgement that what was sitting in the vault was insufficient to cover the contractual obligations of the exchange. And that repriced price gets set in the context of an active White House directive mandating price floors. Active negotiations across 6 major trading partners over exactly those price floors. A global physical market already trading at significant premiums above the COMEX screen price, and a Chinese exchange accumulating silver at record pace while restricting the processing inputs that produce new supply. Cash settlement does not protect the paper contract holder. It compensates them in dollars at a price that reflects the moment the institutional fiction was acknowledged. And the people who are protected in that scenario are the ones who already hold the physical metal. Because the physical metal does not settle for paper. It settles for whatever the repriced market is willing to pay. Now let me give you the debt picture, because this is the macro foundation underneath everything else we have discussed. The United States currently carries approximately $36 to $40 trillion in national debt. At the current average interest rate of approximately 4%, the annual interest expense is running at roughly $1.3 trillion. If that average rate were to climb to 12%, a level still far below the extremes reached in the early 1980s, the annual interest expense would reach $5 trillion. The total federal tax receipts collected by the United States government in a full year are also approximately $5 trillion. Every dollar of tax revenue gone entirely to interest payments before a single federal program is funded. Before defense, before Social Security, before Medicare, before anything. This is not a projection of what might happen if policy goes catastrophically wrong. It is the mathematical ceiling on how high rates can go before the federal government becomes technically insolvent on its interest obligations alone. That ceiling is already visible from current rate levels, which means the long-run direction of rates from here has only one viable path, and a sustained declining rate environment, in the context of a multi-decade debt load this large, is an environment that structurally rewards hard assets, specifically hard assets with simultaneous supply shortages and accelerating industrial demand. Silver tonight is both of those things at the same time. Here is what all of this ultimately means placed inside a single frame. You have a futures exchange with 135 million ounces under contract and 77 million ounces in the vault, facing a delivery test in 4 days. You have a registered inventory that has been cut in half in 6 months with no sign of stabilization. You have a documented pattern of exchange outages deployed at the exact moment when delivery pressure peaks. You have a White House directive with a hard deadline in 78 days, mandating price floors for the commodity at the center of this stress. You have gold options accumulating at strike prices that only make sense if a planned policy revaluation is coming. You have China importing silver at the largest monthly VO, loom in recorded history while simultaneously restricting the processing inputs that produce new silver supply globally. And you have 3 separate government deadlines from 3 separate policy tracks, all converging in the same 30-day July window. Bank of America, not a fringe newsletter, not a speculative podcast, but one of the world's largest financial institutions, has a published research forecast for silver ranging from $135 to $300 before the end of this calendar year. That range was not constructed by looking at the daily price chart. It was constructed by looking at exactly the kind of structural supply and policy data we have walked through tonight. The thesis is not fringe. The timeline is not vague. The signals are not subtle. The question you need to answer for yourself before Thursday, before the window for calm analysis closes, is what position do you want to be in when the July convergence arrives? The people who act on structural information before the event are not speculators. They are the ones who did the work. This is Recession Warnings. If this analysis gave you something the mainstream financial press did not, consider sharing it with someone who needs to hear it. And if you are not subscribed yet, now is the time, because July is coming faster than most people realize.